What's my edge in oil trading? Conviction. With Sparta Curves, I get real-time, trusted prices from 30-plus top brokers. Futures, swaps, physical, and freight, all in one place. Switching from Bloomberg or Refinitiv only took 15 minutes, zero disruption. Now, our whole team runs on one flow. Sparta Curves. 45 days. Free. No risk. No friction. Just conviction. Start your free 45-day trial by visiting spartacommodities.com/curves.
Welcome to Sparta Market Outlook, your go-to source for the latest oil market trends, insights, and strategies. In this podcast, Sparta's team of analysts and experts break down complex market information into actionable, forward-looking insights, helping you make informed decisions in a volatile market. For traders who want to anticipate future pricing trends and seize opportunities before their competition, Sparta provides real-time, actionable market intelligence. For more information about Sparta or to book a demo, visit our website at spartacommodities.com. Now over to your host, Sparta co-founder and CEO, Felipe Elink Schuurman.
Welcome back to Sparta Market Outlook, your weekly snapshot of what's driving the global oil markets. And I'm your host, Felipe Elink Schuurman. And today I'm joined by Neil Crosby. Hi, Neil. How are you today?
Good, thanks. Yourself?
Very good, very good. And we also have June Go joining us from Singapore. Hi, June. How are you?
Hi, doing well, thanks.
Excellent. So last week was a bit of a speculative kind of pod celebrating our first year anniversary. Today, we're going to go back to our usual content, not so much about these conspiracy theories, which were fun. And we're going to be focusing again on what's driving the market in the short term, which is our specialty, and trying to make some calls into what could actually happen over the course of the next days and weeks. So, and obviously focusing on the physical market because it actually never sleeps. So, Neil, why don't you run us through the status of all the different headlines at the moment? You know, what's driving the markets, the news, the headlines, obviously on a macro, but also on a physical oil perspective.
Yeah, why don't we do it? So in my mind, there's basically two things driving the oil market just now. The one is the potential Ukraine deal. And of course, the meeting is tomorrow as we're recording. And it seems to me that if you look at the price action, it definitely seems like there's a big risk off kind of sentiment going on. So even things like flat price, we're now down to $65, which is getting pretty weak relative to most of the last couple of quarters. I don't know where this leads, though. I mean, there's so much commentary flying around. It becomes very speculative, as you've just kind of said. So we have to go kind of slightly speculative. I think the market seems to be settling on a deal, and I'm not quite sure that is actually what we're going to get tomorrow. It depends what your view is on who can make concessions. It doesn't seem like Putin is going to make concessions. It might be that Trump ends up negotiating some kind of bad deal, at least bad for the Ukrainians. I don't know what you guys think, but it's definitely driving the price down, let's say, just now.
I see here that one of the topics that you also wanted to talk about is India and how US is putting pressure on India, which was something that I remember at the beginning of the year, we were always saying that India is in the best position because they're sort of friends with all parties, you know, and now suddenly they're asked to change. Now, so why do I mention this is because ultimately what we do know for a fact is that Trump is putting pressure on India in order to get a better starting point for a negotiation with Putin. So that is obviously creating a bullish kind of environment because India is now going to have to go back to the market and buy non-Russian material. And that Russian material then doesn't have that many takers, you know, so that is creating a sort of bullish kind of environment. That is what we know. And then the market is now reacting saying, well, yes, you know, he's using this to negotiate a better deal with Putin. And as you said, I think there's a sort of like understanding that the deal will happen. And let's face it, he's been on a roll, you know, he's getting all these deals done. Now, maybe he actually does get some sort of deal. I don't know. It's the fact that they're actually meeting, which was not easy, is happening. But Yeah, I would. It does seem surprisingly optimistic to think that there's going to be a good deal that would justify a risk-off scenario as we're currently seeing it. It does surprise me a bit, yes.
And you can also see a situation where Putin is again sort of trying to play Trump, in that Trump arranges some kind of deal that's horrible for the Ukrainians. The Ukrainians reject it, and then the pressure's all back on Zelensky again.
Yes.
So
I would say Zelensky and Europe, because then
yes,
suddenly of course, Europe has not been consulted on this and anything like that, but then there is this momentum in Europe where, we got this bad deal with US, or that the perception that it was a bad deal, and there is a detachment or a distance that is growing between US and Europe. Will we see some sort of reaction from Europe? Now, historically, the answer is probably no, but will we see a sort of, reaction of Europe siding on, putting themselves on the side of Ukraine and not agreeing with this kind of deal? And what will happen then? I'd like to understand that. Yeah.
yeah,
Well,
or
in the
whether
in the
Europe
meantime,
has. Sorry, Ajay.
I mean, the rest of the world is looking at Europe now and seeing a more, historical highs of weapon defense building internally as well, since this is the kind of the result of what's happening.
Absolutely. I mean, Germany is relentlessly building their weaponry and army, and so is France, and so is the UK. And yes, I mean, that's not something that we should be discounting, for sure. I think that, I was discussing this with some friends last night, and the governments are fully aware of what's going on geopolitically and all of the spending on army and defense. I think it's more the sort of voters that are not fully aware of the potential, risks here for Europe, and it's something's, it's changing, if you want, and we need to keep an eye on it. I think that this whole first move with Putin and Trump is the first move in the chess piece, but it's definitely not the last one. And discounting everything right now, I think, is surprisingly optimistic, in my opinion.
And just to sort of carry on from that, to get back to the physical oil market,
Yes.
One of the things that has surprised us, or surprised me, I guess, the last week, you could say, has been characterized by the market has seen that India is definitely buying less Russian oil and definitely buying more spot crude from the legitimate market. And there's not really been a very bullish price response to that. At the same, in terms of flat price, it's just gone down. Spreads are, I guess, holding up, but they're relatively weak still. I mean, I'm jumping back and forth a bit in terms of our script today, and there's not really been a reaction in spot Middle Eastern diffs. So I'm kind of surprised by it. I don't fully understand it. I guess there's some kind of assurance that, we've seen some evidence that Urals is being offered to the Chinese at bigger discounts. So there's some reassurance that the Chinese will take up some of the slack. So that might be why there hasn't been that much of a price reaction. But I think the market's very relaxed about the fact that India is already ejecting Russian crude and buying more and more oil in the spot market.
Yeah, it is. I mean, again, maybe it's this meeting that suddenly everyone's very optimistic about, and to a certain extent, hopefully it's the case. But so what's next? I mean, let's talk about India particularly. So they have a 21 days window to appease Trump. You're saying that they're now starting to buy other sources, the legitimate oil. What do you think is going to happen?
Yes.
And
well, it becomes speculative again, but let's just say there's a distinction forming between the NOCs and the private refiners in India, right? Some of which have term deals with Rosneft, very long-term ones. And the question becomes, what happens with this meeting tomorrow? And then let's assume there's no deal. What else do the Indians have to do to avoid this extra tariff? So there is the 21-day pause, if you like, or grace period. If there's no deal tomorrow, do the Indians have to do more? As in buy less and less Russian and buy more and more in the spot market. That, to me, seems to be the risk if we don't get a deal tomorrow, basically. And the market, again, looks just very relaxed and everything. And there's lots of other things that are relaxed. The gas oil cracks, for example. Gas oil cracks look kind of relaxed and so do spreads, for the fact that Indian runs are at risk and Indian yields are also at risk. So India has been buying lots of light crude to replace Urals. And that is something that should be bullish for gas oil cracks. And there's another piece of news, which is the Nayara refinery, which is probably going to have to run a fair bit lower. They're taking much less crude. There's a report today, if I got that right, June, that they had to send a cargo of diesel to China because it had nowhere else to go. So that seems to be like a kind of risky environment there. And cracks are not doing very much. In fact, they're down today. I think it just looks very kind of primed to the upside if we don't get a deal.
Yeah, I fully agree with you. And on top of that, the fundamental picture is, what would you say about it? Your commercial crude and product stock change is still unusual. What would you say about that?
Yeah, that's the one bit of the puzzle I keep thinking about just now. So you'll recall that often this year we've talked about the status of OECD oil stocks, basically. And the last 4 weeks, there has been a material step change. So if you look at the US crude and commercial product stock builds over the last 4 weeks, they're about 700,000 barrels a day higher than last year. They're very, very bloated just now. There's a couple of caveats. One of them is low export data for crude. One of them is bad implied demand data. My point would be, this is actually a very important signal. And if it doesn't start to calm down soon, we should start to make some inferences about how tight this market really is. Because if you're building stock at a far higher pace than normal in the US over many weeks, then something is wrong. And we know, for example, that TI demand in Asia is very poor. There's customs data that shows TI exports to Asia were down almost 1 million barrels a day in June, which is huge, some of which is structural. So it does seem like there's generally something going on in the US data, and we'll find out this afternoon if that's going to carry on.
Diesel stocks as well, have been kept lower. What else can you say about the stock levels?
Yeah, diesel is one of the drivers. So the diesel has been very low in terms of stocks, and now it's one of the drivers of these big builds. And what tends to happen is you get, if the US starts to refill, then Europe starts to refill. We know that yields are up in the US. There's more heavy crude coming back to market, a lot more. So that's also a kind of bearish picture. It can turn around, but I just think it's important to point these things out just now. It's maybe one of the things that's driving price as well at the margin.
But supposedly, I see here that we're expecting a decent draw in European distillates for July. Is that, what would that tell us, based on what you're telling me on the builds in the US?
Well, July is, some weeks ago already, right? That's one thing. You remember we got that very bullish expiry in ICE gas oil a few weeks ago. Maybe it was front loaded in the sense that the start of July was very tight, and that's where we saw that very bullish expiry. But since then, there's been a step change. And if you look at gas oil spreads, it's a fairly weak expiry yesterday in the August contract, and spreads look remarkably relaxed relative to last month. So I don't know. It's on balance. I'm not quite sure what to talk about. I can talk about distillates later, but it seems like there's been a step change in supply in diesel, let's say.
Okay. And the other news as well, Dangote, June RFCC is down for 15 days from August 10th. What is the impact that we're seeing that you think we have?
The news basically started like last week. No surprise, we expected MOGAS to go up, and EBOB cracks and Sing 92 cracks have surged since then. On the dirty freight side, the Suezmax 130 KT from Dangote to Singapore has also been up $8 to $9 per ton at its peak. I think the last quote is about $5 per ton versus the end July. And Dangote LSSR FOB, we haven't seen a number out yet, but we are expecting it to likely weaken rather than the East-West to firm up. Of course, we just want to remind everyone it's not easy to restart a RFCC. It is a very temperamental unit compared to a VGO FCC, and continue to expect potentially longer than that 15 days outage that was reported.
Yeah, no, fair enough. That's a good point. And I still remember when I was working at VP in a refinery, you would not play around with the FCC or FCC. That's definitely something you don't want to touch.
Yeah, it's so difficult to restart, and
it's so
if you upset the unit, yeah.
Let's move on to specific products. Maybe let's start with crude. June, still with you. Let's talk about Saudi allocation, OSP, anything to read into it.
For Saudi allocations to China, it's down to about 43 million barrels allocation. It's at a 4-month low. This is, we are thinking, number one, is it OSP got too expensive, so Chinese nominated less? It's probably a big factor there. And secondly, of course, whether the Chinese are actually making room for more other crudes, and the other crudes is that Urals. There is some talk potentially the NOCs might not want to touch it again in case there's further tariffs applied onto China. But then, teapots and mega independent refineries probably still have the appetite to take it if the price is right. Just on that point, I had another conversation with another trader on this. His view is actually it's not so easy to replace Urals with Iranian into China. Looking from logistics point of view, Urals has to go via from Ust-Luga up north with the icebreaker to get into China, or you go via the long route via the Cape, versus the Iranian barrel, which is more straightforward. So it's really not that easy to replace Urals with Iranian as well. Okay, in terms of the Saudi allocation, maybe they have also more term crude to offer post-burn season coming into now the September-October loaders. And maybe just to highlight to the rest of the people not following the physical market, today is the Qatar Energy tender, which usually kickstarts the spot trading for the month. There's 3 cargoes out on offer. It's shorter than the typical 5 spot cargoes. We will, of course, monitor how that tender results will be, as that will set the tone for the rest of the PG spot market, which we think is on the weaker end. Notably as well, I heard some maintenance on the Al Shaheen and UZ fields, but that doesn't seem to affect the expected length in overall medium sour market.
Thank you, Jun. Moving on to you, Neil. We've talked about this. The risk remains on the Ukrainian, Russia, US, India saga. And there's a million question marks. But what are the firm statements that we can make right now? How do we provide a bit more clarity into the picture?
Yeah, I think we've covered some of this stuff, so I'll just go very quickly. And I also want to sort of fire a question back to June related to this and what she's just been saying. So maybe one of the explanations for why the market is relaxed about the situation just now is that there's evidence that there is a lot of reshuffling going on already, right? So we've just talked about Saudi allocations to China being relatively weak, with UNIPEC being the kind of swing. There's talk about the Indians taking more Saudi term supply in September. And I'm wondering why the spot Middle Eastern market so far, in terms of diffs, hasn't, in fact, it's just weakened over the last week very slowly. And I'm wondering why that is when there's evidence that India is getting rid of Russian. And maybe it's because there's so much reshuffling going on and there's kind of evidence that this is working out so far. But the one thing I also wanted to ask June is to do with the physical cycle. Is the next 10 days going to be more indicative of the market than, let's say, the last 10 days or the 10 days we've just had, because that's before the start of the Al Shaheen tenders? Is that a fair statement or not?
Most definitely. I mean, anything from the 1st to maybe the 13th or 14th of the month in the AG, premiums don't really matter. So we will know today actually or tomorrow.
So the next 10 days more important to judge the strength of the Dubai market, let's say.
Yes.
Okay. That's an important one, because then we still have time to see the net effect. And I'm wondering if there's a really net effect and people say, okay, the reshuffling looks fine, there's nothing bullish here. Or the net effect is also the fact that there is just more supply coming out of OPEC because it's September. That's the month we've been targeting for ages regarding, okay, it's after the crude burn and the Saudi is going to ramp up. And then there's also turnarounds going on. So the Asians are already buying in basically the peak turnaround period, or just about. So maybe the net effect is just there is still enough crude around, and that's why the market's so relaxed. And I can see that that's also becoming a relatively convincing story. So, yeah, I'm not quite sure where that leaves it. It seems like there's enough crude around just now. Let's put it like that.
Yeah, and we also saw that the spot MEG diffs are actually softening.
Yeah, that's what I mean. But maybe that's less reflective of. It's just not that important relative to the next 10 days. Yep. I think that's what we're kind of settling on.
Yeah. So then the question is about WTI and Brent and that spread outlook. What is your opinion on that?
Yeah, so it's all related as well. So it does seem like, unless there's major Russian disruptions, we are moving into a slightly softer market. And one of the key themes of the summer has been there wasn't a lot of residue around. TI was increasingly put into the US crude slate. That's why the numbers, the sort of monthly figures for the US crude slate were very, very light. And the view now is, or something we put out on Monday, we wonder if TI needs to get a lot cheaper from now on, because we know that US crude supply has not been that responsive to price yet. So I'd say surprisingly strong. We know that there's more residue coming back to market. So broadly speaking, global slates are about to get heavier. And so what becomes the marginal barrel? The marginal barrel becomes WTI, and that's more of a kind of medium-term view that should start emerging now. And then the short-term view is Cushing stocks are rising, US turnarounds are approaching, and there's more OPEC supply back to market, and TI arbs are already relatively cheap, but the one firm statement might be if that becomes the more and more the marginal barrel, it simply needs to get cheaper. And I think that's why we came up with this view, at least on Monday, that even though we were at minus 360 TI Brent spread, it actually needs to widen out a bit more. And so far, it's working out. We're at minus 375 today. So I think we kind of double down on this little view here for more widening.
Okay. Anything else to note on the crude market? Maybe I see some startups happening.
Yeah, there's a bunch of startups also in the West of Suez. Some of them don't get a lot of, let's say, news coverage, but apart from Brazilian supply and stuff like that, there's more Guyana crude that's come to market. There's another startup which is big, the Yellowtail startup, that was last week. And there's stuff in the Gulf of Mexico, or the Gulf of America, as it now needs to be called. There's the Shenandoah FPSO, that's another 120 KBD going into the Southern Green Canyon stream. BP has a startup. There's Venezuela's return back to the US Gulf. So it's all going in the same direction. There's going to be a lot more resid around from next month, or let's say for the rest of the year. And that's bad for WTI, I would say, in terms of pricing.
No, that makes sense. Moving on to light distillates, if that's okay. June, I've seen a lot of customers approaching us with regards to the organic chloride story. Can you tell us more about it? What happened and what's the impact and what you think is going to happen next?
Okay, so it started with crude. Back on the 23rd of July, it was reported that the Azeri BTC crude had organic chloride contamination. We also heard that ENI and OMV received some of this crude into the refinery unexpectedly. And then the FM or force majeure was announced around the 1st or 2nd of August. What I understood is the loadings continued even after the FM was announced, but there was more thorough checks on each cargo's organic chloride level. What does it mean, right, for organic chloride? Number one, it is very difficult to manage, and you try to not get it into the refinery if you can, and you do the blending of the crude outside of the refinery. That would be the most ideal situation. But in this case, the crude went into the refinery already unexpectedly. And once you do that, you have to control the blend so that you don't have significantly high levels of OC in the overhead section, and as that will cause corrosion. Corrosion in the overhead section will mean you need to down the entire refinery because the CDU cannot run. I think we didn't see that happen, so there was likely enough blending in gate for all these refineries that receive that oil, but you have to still feed that crude regardless, and that number of naphtha contamination gets concentrated there. The organic chloride has a spec of 3 ppm in naphtha, which is the limit, particularly for the petchem side, for the crackers, they are very sensitive to this organic chloride, further corrosion in their steam crackers. So we've heard this week now that cargoes of the naphtha went up to 10 to 20 ppm range on the organic chloride versus that 3 ppm spec. The question then, how do you solve this problem? How do you solve this off-spec problem? When I did my calculations, assuming a typical organic chloride content of just say 0.5 to 1 ppm of the naphtha in the market, blend this with that off-spec cargo 10 to 20 ppm, you will need 1 to 3 or 1 to 9 ratio of the off-spec to the on-spec cargo. So that's quite a lot to blend to get it on spec. Another way to get it on spec is you blend the naphtha into gasoline, which apparently gasoline doesn't really care about the organic chloride content. So, you got two ways to solve the problem, but the bigger issue will be for petchem purposes, that naphtha is short.
How many cargoes are we talking about here?
I don't have the exact number. Yeah.
Mm-hmm. Okay.
But definitely it has raised enough concern such that we saw it materialize in the Northwest Europe time spread. We saw that for naphtha, it's gone up quite significantly since the announcement of the earlier contamination. And secondly, we also saw it in the East-West naphtha box, where the August spread has really also risen has widened quite dramatically. Yep. So the price is telling us it is a problem.
It is a problem, yeah. And the market in the East, is it perturbed? Is it, do we see the impact or not?
Currently, it's confined quite much to the Med, and Northwest Europe naphtha shortage is probably slightly temporary. and confined again within August. The East is already trading second half September right now. So, this is an August problem and likely to resolve at most probably early September. So it's now it's a prompt issue that affects only that Med region and maybe Northwest Europe.
Okay. So looking at August, September spreads, anything, that we foresee, or do you think that that's sort of a story that would clean itself up, or?
Yep, I think we had some discussion with Phil on this. We think that the problem will go away. Of course, it will be blended away, and gasoline is the ultimate sink for the cargo for these off-spec issues. But we are not so sure whether it will go all the way to sep-ox spreads. Yeah. Neil, you got anything else to add for that?
No. I think there's an interesting to relate it back to crude as well. So on the crude side, obviously Azeri is very cheap just now, and one result is that CPC, which is the other Med alternative, I suppose, was bid up slightly. CPC in our signals dashboard is now a 1, which is the most expensive it can be, which partly relates back to the cheapness of Azeri. But CPC looks a bit expensive, and one thing is that lots of North Sea light sweets now look quite cheap into Med, which is an interesting signal. So North Sea has a lot going for it just now. So it's unusually cheap into the Med. And if you look at things like 40s, they're as cheap as they really get in our history going into China or the Far East. So we're wondering if that's a point at which the Chinese can step in as well. And yeah, it's kind of a bullish setup for North Sea very specifically right now. So maybe that has an impact on the DFL and probably goes in our direction of TI Brent as well, happily. So it's a nice way to square that circle even.
Yep. Let's move on to distillates then. We touched a little bit about it at the beginning, talking about stocks. What's the current situation and the outlook for the distillates market?
Yeah, I'll go through it relatively quickly. I think I'm starting to get, let's say, very mildly bullish relative to where we are just now, because I know that's at odds a bit with what I said at the start of the pod, but just the very short-term outlook. Apart from the fact that the market looks really relaxed about supply disruptions, and that includes things like Indian runs, it includes things like there's been lots of drone attacks on Russian refineries this last week, 3 or 4 I think by now, which has quite substantial KBD value attached to it just now. So there's non-OECD risk. The other thing is that ICE spreads, front spreads they're weaker than we've seen over most of the year, and what that essentially means is that a lot of the ARBs into Europe are now closed. So even the Sika barrels loading in September, those are pointing east again. The Gulf Coast ARB, the Gulf Coast MR ARB into Europe is quite closed once again, partly on the strength of the HOGO still. TC14 was very bid up. It's starting to correct now, but that marginal ARB looks very closed again into Northwest Europe. So you've got that, which will presumably impact inflows rather towards the end of the month or next month, plus turnarounds. I just think maybe things look like they could slightly improve with a low ceiling in terms of ICE gas oil spreads over the next couple of weeks, all else equal. That's really it. I think, maybe distillate's not quite out the woods yet. So we're talking about the levels of stocks in Europe. Yeah, a bit of a counter-seasonal drop probably in July. Maybe we just need a bit more time, and it's rather towards the winter where we start to see the cumulative effect of just the step change in yields and supply just building up over the winter. Yeah. Okay.
So that wraps it up for distillates, I would say, unless, June, you have any other comments. But so let's do a quick fire round. MoGas, who wants to talk about MoGas? Is it you, June, or Neil?
So MoGas side, we're still seeing a weak MoGas components market in Europe particular. EBOB is wide open for blend margins, and a close RBOB up margin means we are bearish EBOB as soon as Dangote is seen ramping back up again. And reminder, it might not happen as, the 15 days, within the 15 days. Secondly, the east of market has been getting support from, number one, Indonesia returning to the spot market based on what we heard from some reports. Lower Chinese flows, again, this is reportedly so. We do see the landed disk from China starting to rise, which I think just last week we was seeing it really dip to the multi-month lows. We also see potentially lower Indian MoGas supply. West Coast India barrels can now go into AG or Singapore, but the lower throughput that we are expecting from Nayara and maybe partially elsewhere if the timings don't match up on the crude switch will likely support the wider East of Suez Mogas market right now.
Okay, so that wraps it up for, that little Mogas section, as we didn't have Phil today. But next week we'll be talking about fuel oil with Juan. But I think this is it for today. Thank you very much, guys. It's been a great episode. Looking forward to speaking to you next week. And if you are on holiday, then enjoy the sun and the beach and the parties. So I'll see if you're working, then I'll see you next week then. Thank you very much, guys.
Cheers.
Thank you.
Cheers.
Thank you for listening, and we hope you enjoyed the podcast. For more information about Sparta or to book a demo, visit our website at spartacommodities.com.